Hey everyone, Dutch Bros stock has been getting a lot of attention in the stock market lately. So I kind of wanted to do a video to highlight why everyone is talking about Dutch Bros stock. And to get those insights, I'm going to look into its earnings call, the latest update, to look at its operations to see what's going on here. Why is everyone talking about this company? And so they now have 438 company operated shops after opening only 37 shops, after operating only 37 shops at the beginning of 2018. So a more than 10x increase in 5 years. Rapid growth here, and investors like companies that are growing rapidly. So company shop sales grew 33% and company shop profit contribution grew 76%. That's good to see that contribution profit is growing faster than revenue. That demonstrates economies in scale. I like to see that when I'm investing in growth stocks. So labor costs were 28% of company operated shop revenue. That improved 400 basis points from the same period last year. That's good news. The company spent $19 million in higher wages in 2022, and they're offsetting that by increasing prices. So Dutch Brothers is not the only one that's been increasing prices. Many businesses have chosen to pass along higher costs onto their customers and say, you know what? We're facing higher costs to operate the business, so we have to raise prices. We're sorry, customers, but it is what it is. We have to do it. And that's having implications because customers are not saying, oh, okay, here you go, here's our money. Customers are saying, you know what? If we have to pay higher prices for your stuff, maybe we don't like it as much. Maybe we don't want to buy it as much. And I think we're going to see that here in a little bit with Dutch Brothers. So in the first quarter of 2023, they enjoyed the full benefit from labor operating standards implemented in late 2022 when we began increasing productivity, optimizing schedules, and resetting standards. Yeah, that's a lot of fancy jargon. All that really means is labor conditions have improved from 2022 into 2023. Remember in 2022, there was companies offering as much as $1,000 bonuses if you would sign up and work there. Companies like Amazon, McDonald's, and others, Starbucks, were saying, hey, come work, come join us, and we'll give you $1,000 bonus. We'll give you higher wages. We'll pay for your college. We'll do this. We'll do that. Companies were jumping over themselves in 2022 to try and attract employees because there was a significant labor shortage. And so those problems have eased significantly in 2023. You're not seeing those sign on bonuses anymore. Overtime, especially overtime, you're not seeing so much overtime anymore because companies like Starbucks, like Dutch Brothers, they have enough people where they can operate effectively, efficiently without having to offer overtime to employees. They can focus more on part time employees, which require fewer benefits. And so these types of optimizations is what Dutch Brothers is talking about here from 2022, where it was absolutely terrible in terms of if you were an owner operator of any business to try and get labor. In 2023, it's getting better. It's still not great, but it's getting better. So yeah, they executed. Not only did they increase prices on customers, right, menu price increase, but they also increased prices sold to their franchisees in the third quarter of 2022. So the company operates on a mix of franchisee-owned business and company-owned businesses, and so to their franchisees, they said, you know what, to buy the materials and to buy the things you need to operate your business, we're going to raise the cost because inflation is hurting us. We need to pass those along to you. And as you might imagine, franchisees are not thrilled about that. And that decreases the appetite to open a new location. If you see, hey, prices are going up, my profit prospects are not as good as they were last year. So, like I mentioned earlier, the company has grown aggressively, more than 10x store growth in the last 5 years. That's come at the cost of some debt. So they finished the first quarter with 236 million of net debt. That represents an increase of 45.2 million from the previous quarter, and that's directly tied to those record openings they reported. So essentially, they're borrowing money to open new locations, and it remains to be seen if that's going to be a smart strategy instead of focusing on trying to get franchisees to open new locations. So for the rest of the year, the company expects total shop openings to be around 150, and 130 of them will be company operated. So only 20 franchisee openings out of the 150. Again, I continue to gripe about this fact every video I do about Dutch Brothers. Not enough growth from franchisees. I'd like to see more. For the full year, revenue in the range of 950 million to 1 billion, and same shop sales growth estimated to be in the low single digits. That's really good news for the rest of the year because the first quarter, same shop sales actually decreased by roughly 2%. So if they're expecting low single digits for the year, that means the second, third, and fourth quarters are expected to be much better than the first quarter, which is great news for Dutch Brothers stock investors. But that's all I've got for this video, just highlighting some of the reasons why everyone is talking about Dutch Brothers stock. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.